Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Wednesday, January 25th, 10:30 a.m. in the UAE. I know it's a little bit earlier in London, so thank you, and to Switzerland and Geneva, not as early, but still early, and we appreciate you guys joining us to give us your thoughts on the direction of travel in the energy markets. We're seeing Brent open this morning a little bit sort of up again after a slight correction yesterday, but still sort of hovering in that range of the mid 80s on Brent, kind of up and down, but not really breaking out despite all of the dramas in the headlines, and most notably overnight, for me at least, is the US and Germany agreeing to send tanks to the Ukrainians and what that means for an escalation in the war in Ukraine. But I want to kick off this morning with all things shipping. Rustin Edwards, head of fuel oil procurement at Euronav. Rustin, happy new year, and thank you for joining us. I wanted to get your thoughts on this report of the FT today. Weaker international demand for Chinese goods has led to a rise in shipping cancellations at the country's biggest ports. Is shipping in a starting 23 in a discounted stress space? What's your thoughts at the moment regarding shipping and its outlook?
Well, I've always said that freight has always been the leading edge of what the world's economy is going to look like in about 6 to 8 months. And right now, container freight rates are in the doldrums, if not sinking fast. The market has corrected massively from where we were this time last year. If you remember, $20,000 to ship a box from Hong Kong to Los Angeles. That same box is now about $2,000. There's been a massive price correction, and it basically tells you that there is no demand on the consumer side. So you have no pull of goods from Asia into Europe and the United States. And there's no overproduction from factories in China that need to push goods out the gates. So they're asking for more box to ship things out. So it kind of puts into perspective, well, what is China's recovery going to look like post-COVID? And that's where I think markets have gotten a bit ahead of themselves, is that and from the actual factory within China and the actual figures of what are their needs for freight just aren't there yet to justify the price move that we've seen in oil over the last 10 days. Tanker freight, on the other hand, they had a very good year going into Q4. So far this year, it's been fairly muted, which is very interesting as we're going in closer and closer to the EU price cap and the G7 price cap on Russian products coming out. So we haven't really seen the appreciation that we saw in tanker freight for dirty products for clean products, because primarily the Russian embargo is going to impact gas oil, naphthas, jet fuel, which all require clean tonnage to move. Yet we have yet to see the same action as we've seen on crude oil tonnage back when the crude oil embargo was being put in place for December 5th. So I think we still see a very strong and supportive tanker market going forward as the extra ton miles that are going to develop around the Russian flow will continue to shake out in the marketplace. I think from the container side of the fence, it's going to be a hard row to pull. So you need to have that economic growth in the demand center of the world, the United States and in Europe, in order to pull products out of Asia. And that demand growth isn't there, especially now you've got more recessionary pressure more than anything else in the Europe and the EU and the United States. So it is a case of container freight may be suffering where tankers might have a good year.
Daniel Richards, MENA economist at Emirates MBD. There lies some of the challenge, isn't it? Clearly, lower freight rates, etc., is good for lower inflation, and maybe the Fed and others, the sort of parlor game at the moment. How tight will the central bankers still go? Where are your outlook on where Fed rates and central bank rates are going in the coming months, and what a factor that might be for economic growth?
Sure. Yeah, just on shipping quickly. I started off as a shipping analyst. So the last couple of years, when actually seeing shipping companies doing well, when I used to do it, I was just talking about overcapacity constantly, everyone losing money. So it's quite heartening to see. But obviously that wasn't going to last forever. You know, there were very idiosyncratic circumstances.
You left too early, Daniel, before the big,
yeah.
the big bumper.
I waited long enough, but
the big bumper bonuses came last year.
Yeah, but you know, people's spending changed from things to experiences as we could go out and spend again, and it was inevitably going to happen. And that demand has then also been hit further by the cost of living crisis, the inflationary pressures, and the, as you say, the Fed hiking. We don't think the Fed is done yet. You know, markets seem to be getting quite exuberant through the start of the year. Everyone thinks that pivot might be coming soon, despite, you know, we still have consistent pushback from Fed officials, and even more so from FOM's ECB officials just recently. So the next meeting's coming up. We think 25 basis point hike. All right, it's not 50 or even a run of 75s we had, but we think there's another 25 to come after that. And then we think it's going to be held probably through towards the end of the year at least. You know, the core inflation has come down, but still 5.7%. That's still way higher than they want it. And even, you know, the headline's still 6.5 in itself. So it's a much better situation than it was. Some of those
is that the point ultimately, Daniel, that I mean, it's not so much at this stage where, you know, the rates, whether it's another 25 or another 225s and a 50 or whatever, but more the real focus should be how long it's going to stay at that plateau, because there is a disconnect between the market's expectation of a declining rate before the end of the year, but the Fed signaling holding higher for longer.
Yeah, and of course the Fed's always going to talk strong anyway, right? They want to really you know, clamp down on this inflation. That's been their focus, you know, since they got over transitory language. But you know, it does seem that they are intent at holding it there. Whether they follow through on that remains to be seen. But when you look at all the other data, okay, housing sector data, that was really the canary in the coal mine that started to show signs that those rate effects were having a hike pretty quickly. But labour market's still holding up pretty strongly. And even think, you know, other, you know, retail sales, all of these are starting to show a bit more of an effect, but not to the degree that perhaps you'd expect to see given that level of hiking, or even that the Fed would want to see in order to bring down the wage growth, in order to bring that down that headline and core inflation level.
Jamie Ingram, senior editor of Middle East Economic Survey. Jamie, the oil markets seem to be in a different plateau than, or different universe than the worlds that Rustin and Daniel are describing, weakness and outlook for you know, further rates and constriction of economic growth. And yet oil markets are continuing to rise. Will the China reopening just trump everything?
Morning, Sean. Yeah. I think it's worth pointing out as well that a lot of these recent gains in oil prices that we've seen have been reversing losses that we actually opened the year with. So I think we opened the year around 85. We're now around 86 on Brent, going a bit higher. So that's something to bear in mind, that the bullishness over the last week is just kind of taking into account for a bit of a bearish start there. But definitely the narrative has been extraordinarily positive on the economic front when you speak to people in the oil markets, and yet it's not that the economic news is good, it's just that it's not as bad as people were concerned about a few weeks ago, a few months ago. So yeah, we're still going to see the rate hikes, inflation's still going to be high. That's going to have a big impact on economic growth or otherwise in the UK, in the EU, in the US, and that's going to have a big downwards impact on oil demand growth here. But I think that China is the big play that everybody is looking at right now, and especially if you look last week, we had those big reports from OPEC and the IEA come out, EIA the week before that, and everybody's looking at kind of 500 to 800,000 barrel a day growth in China. The narrative is China is reopening. This is going to be great for demand. This is going to lead to shortages in the second half of the year, effectively, and that's what's pushing up these recent price movements that we're seeing.
We saw overnight, of course, the Microsoft results, seeing the slowest sales growth in 6 years, layoffs across the tech sector. So the sort of bearish signals still remain there. The 1st of January, of course, the IMF, head of IMF famously forecast that over a third of the world's economies would go into recession this year. That seems like it was, that's pre-Davos, I suppose, in so many ways, PD, and so somehow irrelevant. Rustin, I wanted to get your thoughts on, obviously we're on the doorstep of the next layer of EU embargo on Russian products coming in on February the 5th, and your outlook for that. It seemed all the efforts last year to curtail Russian crude was unsuccessful. Now India, the biggest oil importer of Russian crude in the world. Where do you see the embargo on products going, and what its relevance and impact for shipping might be?
Well, I don't think the crude and the work that was done with the G7 and EU on the embargo around crude oil was unsuccessful, because Russians' revenues are down, and you did not have a supply shock to the marketplace. So you did a continual flow of crude. If anything, Russia's incentivized to export even more crude because they would need their revenues higher. And, if you're exporting 2 barrels or 1 barrel, all you care about is getting those dollars in the door because you're trying to persecute a war in Ukraine. As we get into the product side of the market, though, that's where there's a bit more of an issue, because the crude oil is a bit easier to find a home for into a refinery, and you can rebalance crude oil markets rather easily. There's enough tonnage to make things move around. The clean side of the fence is where there's going to be more problematics, and you start up to getting into the nitty and the gritty of the products that Russia exports. I mean, when you look at gas oil is fairly homogeneous around the world, and I don't see much of an issue in Russia finding a home for their 600 to 800 KBD of gas oil exports that they have, especially if you're going to replace European gas oil exports into Africa. You can rebalance the whole gas oil book around Africa and the EU. So it actually helps EU supply, because the EU keeps all of their gas oil home, and the Russian incremental gas oil ends up going into Africa and balancing out their books. I think their biggest problem is going to be sitting with naphtha. Naphtha is a petchem feedstock, gasoline blend stock. They produce and export about 500,000 barrels a day of it. And if you don't have that European market to go into for the gasoline blending pool, you're basically exporting into the East for petchem feed. Petchem margins have been pretty poor. Again, plastic demand is not very high. So again, it pushes back on the whole, how good is the world economy if you don't have people buying plastic? But nevertheless, you have to then incentivize integrated Chinese refineries to back out their own internally produced naphtha to bring in third-party naphtha. So naphtha, I think, is going to be the crux of their problem. And I think it's probably going to end up in Russia shutting in a few 100,000 barrels of refining capacity. That's going to be just economically infeasible because they can't get the product out the gate.
Daniel, I wanted to get your thoughts on this story that we have in our digest today, but it's a sort of a continuation of that is banks, commercial banks coming under increasing pressure regarding lending to the oil and gas sector. We have BNP Paribas yesterday saying that they would slash money outstanding with oil extraction and production industries to less than €1 billion by 2030, which would represent an 80% decline. And we had earlier in the week the European pension funds warning banks that they had only 3 years to get their carbon house in order before they started to pull away from their investments into banks. What do you think the sum of the parts is there, and the consequence for oil production and oil prices, where the dominoes may fall here?
That was to me, wasn't it? Sorry, right?
Yes, Daniel.
Yeah. It's a tricky one.
The
right?
banker on the panel.
Everyone's pushing for it. Everyone wants a clean energy transition, but this will essentially make that more expensive. It will make any investment, and obviously we still need oil and gas investment to carry on. It will make that more expensive, or the ESG movement will make that more difficult for that to be done at a price point or for that capital to be available. What it means for the Middle East or for the Gulf in particular, it leaves it that it will be the region of the last people standing effectively. They are not going to be so reliant on this funding from major banks. They have a lower production price points, and they have the reserves. So I guess for the Middle East region, in terms of a transition and being in the last producer standing, it is a positive. But when you look at what that means for energy prices, US producers haven't jumped in this year as you might have expected with those energy, even with the high oil prices that we've seen, I guess, and that is indicative of the kind of trend that we're going down, especially if we have banks at BNP and others moving towards cutting that funding level to such low degrees, essentially, especially if new fields are going to have to be developed. Obviously, that's hugely capital intensive. And if that isn't available, then what does it leave? It leaves energy prices going to be far more.
The outlook here, Jamie, for oil markets in the new year, you were mentioning in your earlier comment about the rebound from the sort of fairly bearish start, literally January 1, and of course holiday time, light trading, big moves during low volumes. But it also strikes me that to a certain extent the markets have removed the geopolitical risk from their calculation in the last few months, and certainly starting the year. Obviously, we're coming up to the first anniversary of the Ukraine war, on which oil prices did dramatically spike up to 130 or thereabouts, and over the course of 2022 came off, and to the point of ending the year below $80 a barrel. Your thoughts of where the geopolitical risk factor is in the oil price, with now announcement overnight that Germany and the US will finally relent their obstruction and send tanks to Ukraine?
Yeah, sure, and you're absolutely right. Obviously, the prices now don't reflect the dynamics in Russia, and Ukraine. Essentially, in the aftermath of that invasion, prices went crazy. Reports went crazy in terms of, we're going to see 1 million, 2 million barrels a day, more than that, come off Russian production, and that simply didn't happen. The most accurate reports were the ones that took a much more cautious wait-and-see approach. We don't think Russia output is going to fall off a cliff. They were proven right on that, and so as we've seen this crude embargo, and now this products embargo coming in next week, at the end of next week, beginning of the following week, actually. Basically, people are just saying, well, we don't believe that this is going to have a huge market-altering impact on Russian crude. I think the reports at the moment vary from about 800 to 1 million barrels a day, quarter-on-quarter drop in Russian output. That takes into account the crude embargo late last year and the incoming products embargo. That's not a market-altering issue there. But where we might see geopolitical risk start to come back in, I think, is in Iran. We've seen attacks, the Houthis in Yemen, Iranian-backed group. We've seen them carry out a number of attacks recently within Yemen, but they've also shown a predilection in the past towards conducting attacks deep into Saudi Arabia, even into the UAE. I'm not saying that they're going to be bringing off significant, if any, amount of production in the UAE and Saudi Arabia, but they are capable of spooking the market, of disrupting transportation of crude and products, and that's an area of geopolitical risk that we probably want to be looking out a little bit more.
We had an announcement overnight from one of the senior IAEA officials saying essentially that the JCPOA talks are dead.
Yeah, absolutely, and that's just a recognition of the fact that has been pretty obvious to a lot of people for a number of months now. So yeah, it's good that it's good from that extent that people have stopped. We're not going to have that dialogue now of are Iranian barrels going to come flooding back onto the market at the end of this year? Finally, this I think puts that firmly back in the coffin. That is not going to happen.
Well, it does look like the US has turned a blind eye to Iranian oil coming out of storage and going into China, which is another factor of easing the stress on the markets.
Yeah, and they are saying that they're going to take a more hardline approach on Iranian exports. Frankly, I'll believe it when I see it. I think they've got enough on their plate at the moment with issues in Europe that, especially given that we've seen with the whole price cap issue, that their priority when it comes to oil is not having a massive supply shock. So sure, then we might have the odd cargo of Iranian illicit exports halted, but I don't see there being a significant drop back towards the days of the Trump administration.
Let's go to the survey question and talk a little bit about this issue with the US and Germany. Obviously, I've mentioned that sending tanks to the Ukraine. What would an escalation of the war in year 2? We're 1 month from the first anniversary of this terrible invasion of the Ukraine as we come out of winter there in year 2. What would it mean for global energy demand, an escalation of the war in the Ukraine? Clearly, tanks on the ground there will sort of alter the dimension, as other heavy weapons have gone in and are about to go in on the Ukrainian side. Will this be bearish for energy demand through 2023, bullish, or no impact? There's different ways to read this particular thing as to where it could go, but Rustin, your thoughts? I mean, one of the sort of logics here is that the window for winning or ending this conflict anyway in favor of the Ukraine is closing. US presidential elections coming up next year, exhaustion in Europe to this conflict, etc. I'm wondering, from your perspective, sitting in Geneva, sitting in the economic health of Europe seems rather good at the moment. Is there an endurance to stay the course with the Ukrainians on this conflict?
Well, I think the mild weather that we've had so far this winter has really helped cushion the blow. Because if you remember back in Q4, there were a lot of stories of, we will be rationing energy, we'll be rationing heat. So I think the collective EU has gotten their heads around how to manage their energy infrastructure, and having relatively warm temperatures for winter have really helped in that regards as well. I mean, when you look at gas oil stocks, they've been doing nothing but build for the last 6 weeks. Now, granted, there's been a lot of Russian imports that have come in, but the overall demand for petroleum into the energy space has not been as high as predicted by the by energy aspects and a few other analytical firms. Nat gas stocks haven't really drawn because, again, we haven't had a cold winter. I guess the guys in the UK will think otherwise right now, since they started to do a bit of rationing and what have you up there due to the cold snap that's hit. But, as we get into about 50 days left in this winter, Europe's probably going to come out of here in better shape than it went into the winter. And that is going to help cushion any type of economic slowdown here. And I think it's going to help keep the positivity around supporting Ukraine going forward within the general population. I think governments internally are going to have a lot more issues around cost of living increase, because you have a raft of strikes being called in France. They have another big strike on February 1st, another big strike on February 7th. Today, the Italian Retail Gasoline Association is going on strike to protest having to publish retail prices that reflect the average price of fuel in Italy versus their own rack price. So you do have these cost of living issues that are continuing to bubble up due to the higher inflation that is caused by the war. I don't think anybody wants to see Ukraine lose.
Daniel, the year starts in the Gulf, of course, after a bumper $100 Brent average last year. Fiscal position in the Gulf states is very positive at the moment. What's the outlook from Emirates NBD for the year ahead regarding where you guys are seeing the oil price curve with all of these issues and where the fiscal well-being of the region is? Clearly, Saudi Arabia still has massive spending ambitions. It needs a lot of revenue.
Sure. So our forecast is for a Brent average of 105 this year, or something on the back of so that's on anticipation, but market tightness in the second half, really driven by China reopening. Whereas when you look at the production side, there's not, you have issues around Russian production. OPEC Plus likely to keep production curves in place for the time being, at least, given what they need in terms of that fiscal inflow. And then we aren't really seeing, like I mentioned, US, etc., not really stepping up either. So our expectations for pretty tight fundamentals in the second half. What that means for the region, real GDP growth isn't going to be the same as last year, because oil production isn't going to grow at that kind of 15% level that we saw for the big producers last year. So GDP growth more around 4%, 3 to 4%, rather than 7 to 8%. for various GCC countries. Most of that, there will be some oil sector growth we expect, whether for investment or a modest uptick in production. So most of that is going to be driven by non-oil sector. And a lot of that, of course, will be driven by massive projects in many cases, especially in Saudi Arabia, which it will be able to continue facilitating through that massive inflow they're still having. The region run budget surplus for the first time since 2014 or so last year, pretty sizable one, given that they kept most of their spending off a balance sheet. What they're doing was rebuilding balance sheets and long-term investment through sovereign wealth funds, right? We didn't go out in terms of helicopter money or raising wages like they might have done in the past. So this year we still expect pretty sizable budget surpluses again, and generally, as last year, the GCC looks set to be one of the global outperformers.
And on that point, I mean, does the GCC, does the UAE stand to benefit as a sort of safe haven for Chinese money looking to exit after now the reopening from China? There's tourism as well, but ultimately we saw a big influx from Russian safe haven, Russians seeking safe haven last year. This year, is there a China safe haven story?
Absolutely. I mean, like you say, there was Russia last year, but there's also, all these hedge funds opening up in the city, moving from Singapore and Hong Kong. It's already kind of benefited from that flow of people. And with the ease of the opening up of China now, that'll probably likely to continue. And that'll continue to feed through into the real estate sector, which obviously went great guns last year. But that contributes to everything. Wholesale and retail, one of the biggest sectors here, benefits from that. Population growth, we don't have detailed census figures, unfortunately, but the city feels so much busier. We read reports of 45% year-on-year growth in school enrollments for some of the major schooling companies, schooling firms here. So if that kind of pace continues, or even half that pace continues, obviously it's going to be pretty robust growth here in Dubai.
Let's get the survey result. Give Jamie the last word here. Bearish to no impact is sort of the dominant view, and we'll put that onto social to get a further wider view on that. I welcome your thoughts on this question, Jamie, and I also wanted to follow up and ask you about the emerging products exports out of the Gulf region. But just to sort of address that point, the idea that an escalation in Europe war could have an impact. This room thinks not.
Yeah, I mean, I'll be honest with you, Sean. I know it's an anonymous survey, but I voted for no impact on that one. I think that in terms of oil market disruption, that's already baked in. Right. Russia has already invaded. They've already committed all of these atrocities. The West has said this is what we are going to do in response to that. Russia does more of the same. Okay, sanctions remaining in place. That's all that's there. I don't think there'll be any massive escalation response on that. Then what was your question about the products imports?
Yeah, we're seeing that we just had obviously the refinery open in Kuwait in recent weeks that announced all of its products going into Europe. Now Duqm is about to open in Oman, and it's signaling that maybe more products going from there to Europe, which would otherwise all have gone to the east.
Yeah, absolutely. I don't think it's going to be a matter of all of this coming over here, but certainly Kuwait is best placed within the Middle East region to take advantage of this. It's not just the new refinery, it's also the clean fuels upgrade at Mina Al Ahmadi and Mina Ahmadi. So we've got Mina Abdullah. So we've got much more Euro spec products that can come flooding out of Kuwait, find a nice new market in Europe where Kuwait historically has quite a good fuel retail distribution system as well. Oman, that's more of an Angier development at Duqm. They've had the first crude cargoes delivered now to start testing the refinery. That's going to take a long time to ramp up. So yeah, Q4 effectively before we can start seeing a big impact of that. Then the other major source of products heading into Europe, I think we're going to find, is a continuation of this trend of more coming over from India and China, and how much of that is going to be based on refining of Russian crude. I think that's the interesting little question there. I think the answer is a lot of it is going to be based on cheap Russian crude. Does the West care about this? Not massively, no. It's something that they're very happy about because it reduces the disruption to their economies.
Well, there we'll have to leave it with Brent trading 86.52 and WTI just above $80. Oil prices markets seem relatively stable given all the drama that's around it. That was my opening comment, and it is my closing comment this morning. Lots of turmoil, but not necessarily having any great impact on the supply-demand balance globally, where everything seems to be cancelling itself out, with some level of optimism that the China reopening is the draw to the upside towards 90 rather than the draw down towards 80, which we saw at the turn of the year. Thank you so much, Rustin Edwards, as always, from Geneva, Daniel Richards from Dubai, and Jamie Ingram in London. We really appreciate your insights this morning. We're here every morning, 10:30 UAE time. All the best.
Thank you very much.
Bye.